Welcome back to New Zealand Property Insights. I'm Paul Roberts.
And I'm Debbie Roberts. We're owners of Property Apprentice, and we're here to help you navigate the New Zealand property market with facts, not just headlines.
Today, we're looking at what could be the real turning point for 2026. With the latest data in, it shows some of the potential oversupply of housing sitting on the market is finally starting to clear and homes are actually selling.
We'll also be looking at a major shift in Kiwi psychology as property appears to be losing some of its appeal as the country's favourite investment. And we'll dive into a major warning for landlords fighting over wear and tear at the Tenancy Tribunal.
So this episode is focused heavily on market timing, investment strategies, and protecting your assets.
Okay, so first segment for today, the market shifts gears, and this is using February 2026 data. We're starting today with the newly released February property report from realestate.co.nz. For the last 18 months, the story's been plenty of stock, not enough buyers. But this new data shows a significant shift in that dynamic.
Yeah, it's a classic supply and demand equation. Sellers are coming back into the market in droves and buyers are stepping up to meet them. So the facts: over 12,200 new listings hit the market in February this year. That's a 7.8% increase year on year and the highest number of new listings for February since 2013. Despite that massive surge in new listings, total housing stock only grew a modest 1.8%. This indicates that homes are being sold rather than accumulating. Southland was the standout, record all new time high, asking price of $584,786. Up 10.6%. Central North Island saw asking prices jump 15.3%, and Canterbury hit a February high of over 738,000. It wasn't boom time everywhere. For Northland, average asking price dropped out of the $800,000 bracket for the first time since June 2025.
Sarah Wood from realestate.co.nz noted that this data points to a market that's beginning to shift as confidence rebuilds, though she does caution that the upcoming election could continue to influence sentiment.
The key metric here isn't the total number of houses, it's the absorption rate. When new listings jump by nearly 8%, but total stock only goes up 1.8%, that tells us that buyers are back and they're absorbing that new stock almost as fast as it hits the market.
For the last year, sellers were hesitant to list because they thought their house could sit on the market for 6 months without selling. Now, with over 12,000 new listings, that fear is evaporating. Sellers are gaining confidence. But as an investor, you need to be ready to move. As properties start selling at a faster rate, your window to negotiate big discounts will start to close.
And that's a big thing we've seen recently. We've had some amazing purchases by clients buying properties under asking price, and that is going to be a time frame that is going to run out. So let's look at the regional differences. Southland hitting all-time high asking prices, while Northland drops out of that $800,000 bracket. This is exactly why we teach our clients to ignore the national average, focus on local data, and buy a house in a specific suburb, not in the whole of New Zealand.
Yeah.
So our second segment of today, has property been knocked off its perch? The ASB survey. So for this segment, we're going to talk about an interesting shift in Kiwi psychology, according to the latest ASB Investor Confidence Survey. Traditional property investment has just been knocked off the top spot as a preferred way to make money.
That's right. For decades, the Kiwi dream was to buy a house and then buy another one to help fund retirement. But this survey shows that KiwiSaver and managed funds are currently being seen by the public as providing the best returns. So let's have a look at the facts. ASB survey shows KiwiSaver and managed funds have overtaken both the family home and investment property as the top performers in the eyes of investors. There's a massive split in how different ages view wealth. The over 60s still hold steady in their belief that the family home is the best investment, probably because they've seen the benefit over several decades of property growth. However, Gen Z and the under 30s believe that the best returns currently lie in shares and DIY investing. Overall, investor confidence actually rose 11% in the fourth quarter, showing that despite global uncertainty, people are feeling better about their money. ASB senior economist Chris Tennant-Brown said that New Zealanders are starting to separate housing as a roof over your head from housing as an investment return vehicle.
So let's unpack why housing has supposedly been knocked off its perch and why, in our opinion, that's a temporary thing that creates huge opportunities for you guys to be counter-cyclical investors. We've just come through a period where medium house prices dropped 17% from their peak. Although, to be honest, they increased about 16% in the 2 months just before that peak. So it was a bit of a false boom. Interest rates also spiked after record lows we saw during COVID, but now we firmly are below that long-term average. At the same time, global stock markets have had a massive run showing really strong returns. It's called recency bias, and that is likely what is making some people think that shares will continue to outperform property.
Absolutely. And we've seen this before where people remember what's just happened and think that's an indication that that's going to continue to happen. And look, as a financial advisor, I'll be the first to say that investing in the share market can be brilliant. Same with KiwiSaver. Just about everyone should be in KiwiSaver, and managed funds are also a great way to diversify to reduce your risk. But you've got to remember the golden rule that gives property investing a massive advantage over the long term, and that is leverage.
Yep, that's absolutely the magic word. And if you had $100,000 in managed funds and it goes up 10%, you make 10 grand less tax. But with property, the bank will lend you up to 80% of the purchase price or the value of the property. So let's say instead of putting that $100,000 into a managed fund, you use the same $100,000 as a deposit to buy a $500,000 house and borrow $400,000 from the bank. If that property goes up 5%, you make 25 grand equity, paper money, compared to the 10 grand you would if your managed fund went up by twice as much as that 10%. So your return on your actual cash is much higher with property.
Your family home's a lifestyle asset. And investment property is a business. It's great to see the younger generation getting involved in investing, but they shouldn't write off property just because of a few flat years. The wealth generation of leverage is unmatched over a 20-year horizon. If you invest in the share market instead of buying a home, for example, by the time you're ready to retire, is that really going to give you enough to cover your rent when average rents increase by approximately 2 to 3% per year? Compared to someone who retires with a mortgage-free home and also uses the benefit of leverage to use the equity in that home to fund the deposits on investment properties? No comparison. Not to mention the volatility in the share market that can dramatically reduce your investment overnight versus property where you only lose money if you sell it for less than you bought it for.
So segment 3 today, we're going to go through the wear and tear trap at Tenancy Tribunal.
We're going to be looking at a major source of frustration for some landlords and what you can do about it. We're seeing a surge of disputes at the Tenancy Tribunal over what constitutes wear and tear versus intentional or careless damage.
So it is a grey area that's leaving some investors out of pocket, and it comes down to a legal concept called betterment, the accounting reality of depreciation.
So let's have a look at the facts. Tenancy Services defines fair wear and tear as the gradual deterioration of things used regularly, like, for example, an oven wearing out over time. Damage is intentional or careless, like if you were using that oven to heat the room until it stopped working. The tribunal relies heavily on book value. If a tenant wrecks a 5-year-old dishwasher, its depreciated book value might be zero. Depreciated book value is basically what's left over after the accountant has written off some of that value over time. In that scenario, the landlord could get zero compensation from the Tenancy Tribunal, even if the appliance would have, under normal use, had plenty of years of life left in it. So what's the betterment rule? The tribunal will not put a landlord in a better position than they were in before the damage.
So, for example, if a tenant ruins a 10-year-old carpet, the landlord will not get the replacement cost for a brand new carpet. They will get whatever the depreciated book value might be, if there's any value left in that at that point. The New Zealand Property Investors Federation is arguing that principle can cause significant financial harm and is asking for the law to be changed to allow for an agreed value for assets, similar to an insurance policy on your car, like an agreed value.
This is a classic case where the law and common sense don't always align. As a landlord, it could feel incredibly unfair if the tenant destroys the carpet that was in good condition and the tribunal tells you it's worth nothing because the previous tenants looked after it so well.
And this is why we constantly tell our clients, don't fight over $30. The article mentioned landlord taking a tenant to tribunal over a $28 mop and bucket. That is a complete waste of time and energy. Focus on building good relationships with your tenants or your clients of your business. They are not just a tenant. And that is the big difference. You treat people the way you would like to be treated.
Absolutely. You own the house, but it's their home while they're renting it from you. The betterment rule can also catch some self-managing landlords out. They might think the tenant wrecked the carpet, they should have to buy me a new one. But property isn't a new for old insurance policy. You have to understand the lifespan of your chattels.
So absolutely the best defense here is great record keeping. If you want to claim damage, you need to bulletproof your evidence of the condition of the item before the tenant moved in. Take lots of photos at your pre-tenancy inspection and during every inspection during that tenancy, or ensure your property manager does, and we do recommend property managers rather than you doing it yourself. But more important factor, repairs and maintenance must be in your annual budget from the point of purchase. Appliances do wear out. Carpets actually need replacing. If you budget for it day one, some years later, you may not need it, but you might. Either way, you won't be relying solely on the tribunal to cover any costs. That's not what they're there for. So that wraps up episode 5 of the New Zealand Property Insights. We've covered the first signs of the market turning, why leverage beats share market investing, and how to protect yourself from the depreciation trap at Tenancy Tribunal.
If this episode made you realize that you might need a stronger strategy, whether that's finding the right property before the market takes off or structuring your portfolio to handle maintenance costs, we'd love to help.
So we run free events called How to Succeed with Property Investing pretty much every week. So please come along to one of those. You can find that on our website, or if you want to book a meeting with me, there's a link on the homepage to book a time to chat.
And these free events are completely free and online. You can find the link in the show notes or head to propertyapprentice.co.nz, and I'll look forward to seeing you there.
Thanks. See you next time.
Hey there. Want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.